we're going to look at the question now. All right, hope it is fast enough. So this is the first question. Now, question 1 to question 10 are related to financial instrument. Yeah. The first question, 9 students got correct. All right, and then the second question all got wrong, by the way. So let's look at the first question first. Shannon Limited acquired derivative on 1st of January X2 for $2,000 cash. Okay, some students may get very confused. Yeah. So the first thing you have to know, this is a question about derivative. Question about derivative does not mean that it is a hedging. You have to look at the question carefully. Over here, there's no hedging. You're not going to apply hedge accounting. So if it is only a derivative question, we know the accounting treatment is always fair value through profit or loss, correct? Okay, so we acquired it on this day. And we said derivative, there are 3 characteristics, right? So one of the characteristics is there is no minimum, there's no payment at inception or minimum payment. Okay, you don't have to pay for it. Or you only pay a minimum of like printing cost, admin charges, things like that. So this $2,000 is actually the minimal payment at inception. This is the minimal payment at inception for a derivative. Okay, now transaction costs were $100. So this one, transaction cost, is to be expense of. You're not going to include into your answer. All right, so end of the year 2000X2, the fair value of derivative was 2,300. Okay, which one is correct? That's the question. Now, you see, which one is correct? It never said I only want the journal entry on 31st of December, right? So it will be throughout the year. Okay, so how do we know it is a derivative financial asset? Okay, acquired. Okay, we acquired, meaning we will debit derivative and we credit cash, right? So I do the whole thing, see whether you can understand. Now at inception on 1st of January, I'm going to debit transaction cost, which is an expense, $100, and I'm going to credit maybe cash because I pay for it, $100, and then now at inception we have minimal cost, so we have to do a journal entries. Okay, so for your normal question, if it is not a very difficult question, normally you don't have a minimal amount. Normally it's 0. So we will debit derivative, by the way, $2,000, and then we will credit cash, $2,000. All right, so this is at inception. However, the question said, what is the correct journal entry to record these transactions, meaning everything, everything throughout the year. Okay, so we will proceed with the subsequent measurement, end of the first year. Subsequently, what we're going to do, the fair value increases from 2,000 to 2,300. Therefore, we will debit our derivative. Normally, I write my journal entry as derivative. It is easier. So no matter it is forward or future, or it is an asset or liability, I also write derivative so that I remember this is a derivative. Yeah, derivative can be an asset or liability depending on the question, and sometimes you don't even have to know whether it is an asset or liability when it comes to a hedge accounting. Okay, so derivative, I'm going to increase from 2,000 to 2,003 by debiting 300. And then just now we mentioned derivative, definitely the accounting treatment is fair value through profit or loss. Okay, and therefore I will credit profit or loss. I will credit profit or loss. It will increase our net profit during the year. It will increase our net profit during the year. So our answer apparently, if you combine them together, you sum them up. Oh my God, I don't want to save this. Okay lah. Later only I check the version history. Okay. So this is our answer. If you combine them, our derivative will then be 2,000 plus 300 equals to 2,003. Okay, our cash is 100 plus 2,000 equal to 2,001. And then our profit or loss is 100 debit side, 300 credit side equal to 200 credit side. Okay, that's what we will do. Expenses will reduce net profit, and this profit due to the fair value change of the derivative will increase net profit. So eventually there's an increase of 200 in our profit or loss. Not too bad, 9 out of 13 got correct. Yeah, so let's look at, I'm not sure whether you remember your answer or not, by the way. Yeah, this is the answer. So if there's a need, I will drag your answer, on Urox. We will discuss about that later if we have time. 4 o'clock we have to join, and I have to, introduce the speaker and so on. So we cannot wait until 4 o'clock sharp to stop. All right, so question number 2. 1st of October, 2000X2, we held inventory with a cost of 800,000 and a fair value of 1 million. Okay, now this requires the knowledge of inventory IAS 2. We will recognize in our balance sheet under the current asset the lower of cost versus net realizable value. So this is the lower one, right? So in our balance sheet, our inventory is 800,000. No matter the fair value is how much. We cannot revalue our inventory upwards unless it is a business combination and it will be done at console level. If you don't know what I say, then never mind. So, okay, now, so in order to hedge, can you see this is the keyword? All right, so we are going to have a derivative, and this is about hedging. Okay, we want to hedge against the risk of falling of the fair value of the inventory, and therefore we acquired a derivative. So this is probably a fair value hedge. Fair value hedge. Okay, because if the value of the inventory drop all the way down until, let's say, 700,000, we have to write off 100,000. Okay, as a written off expense under expenses. So it is like the story we covered before from the study guide. Yeah, we maintain the oil or don't know what like that. Yeah, so we want to acquire a derivative. Yeah, and on 31st of December. Okay, we acquired derivative during this date. And then on 31st of December 20X2, the fair value of the inventory had fallen by 40,000 and the derivative had a value of 40,000. Okay, now actually you don't really have to worry about the derivative asset or liability when you're hedging. There is definitely an economical relationship. Okay, effectiveness and so on. Otherwise, we cannot proceed. So when you have a hedge gain, then you will have a hedge loss later on, or the other way around. Let me double check. Is it all got wrong? Oh, yeah lah, all got wrong. Okay. So I know already all got wrong. Maybe because you don't know this IS2. Inventory, IS2, we will recognize in the balance sheet inventory the lower of cost versus net realizable value. The value can be sold based on the estimated selling price minus cost to sell. It has got nothing to do with fair value. Yang tu fair value, we have to look at derivative fair value, not the inventory fair value. Maybe the confusion is here, I guess. Yeah. So, okay. So what we're going to do, now, you see the question asked 31st of December 2000X2. Okay. How much inventory is to be recognized in the financial statement? The question is trying to ask us in the balance sheet, inventory carry down, okay, on 31st of December, X2 is equal to how much? Can or not? That's the question. So, because I want to illustrate like longer so that you know the logic, and so on. So I'm going to look at this first. End of the year, 31st of December, the inventory had fallen by 40,000. Okay, so what are we supposed to do? On 31st of December, I will have to credit the inventory 40,000, right? And then I will debit inventory written off, which is an expense if there is no hedging. If there's no hedging, then we will do this, okay? However, there is a hedging, so it is okay lah. We will be compensated. Don't know how to do it. We will be compensated by the derivative dealer. And therefore, instead of doing this because of hedging, we will debit hedge loss. Because the question can ask you journal entry also, so myself I just do everything. Yeah. Now, for hedging, it is not too bad. You know, when there's a hedge loss, later on we will have a hedge gain. That's the easiest way to get it done. Okay, so in this case, it say the fair value is 40,000. So there is no minimal cost at inception. So on 1st of October 2000X2, there is no journal entry. Okay, and then on 31st of December, we will debit our derivative by 40K, the fair value. Okay, depends what the question asks. However, if this is an exam setting, if you're in exam, you don't have a lot of time and so on. All of you did very well, you keep your time. Yeah, actually 20 questions, maybe 1 hour, you have to finish. Yeah, so however, I choose the difficult one, so that's fine. If you finish within 2 hours, 1.5 hours, also okay lah, no problem. So you see how to tackle the question. Now the question said I want inventory carry down only, right? So if I am running out of time, only when I double check my answer second round after I finish all my questions, then only I do slowly and double check. During the exam setting, when I know the requirement is only the inventory carry down, okay, I will be able to get my answer very quickly. I will know that, okay, from here, 800,000, it drops by 40,000 to 760,000. Full stop, finish, nothing to continue already. So immediately I will get my answer very quickly, less than 1 minute. Okay, but when you do your revision, you do slowly because the question can change. The question can say, oh, what is the journal entry? How much is the derivative, or how much is the hedge loss, So you have to know everything. Yeah. Okay, so let's look at question number 3. I don't know how many of us got correct. Oh, question number 3, 9 got correct. Okay, so a company owns inventory of 20,000 gallons of oil. I think this question is a bit confused, yeah, but so many got correct. Very good. So you see, we hold inventory of 20,000 gallons of oil, and then the cost is $400,000 on 1st of December. Okay, 2000X3. So 400,000 divided by 20,000 units is equal to $20 per gallon. Okay, so we want to hedge the fluctuation of the market value of the oil. We sign a future contract to deliver 20,000 gallons of oil on 31st of March 2000X4 at the future price of $22 per gallon. Okay, so we enter into the derivative on 1st of December, and then the mature date is 31st of March. All right, and then the market price of the oil, the spot price of the oil on 31st of December is $23 per gallon, and the future price for the future price on 31st of December 2000X3 to deliver the gallon on 31st of March next year is 23 per gallon. Okay, don't get confused. And what's more, the question is only asking us about the journal entries on 31st of December 2003. Okay, so in other words, right, if I only want to answer the question, basically I don't have to bother the 31st of March 2004. It's not my business, by the way. Okay, because the question is only asking us about the journal entries on 31st of December. So I'm going to draw a timeline. I don't know. Okay, wait, never mind. I enter. Okay, I'm going to draw a timeline over here, and let's see. Okay. Okay, like that. So on 1st of December X3, okay, I will start with the inventory first. Okay, so our inventory is 400,000, right? 400,000 is our inventory in the balance sheet. Okay, how about derivative? Derivative, no journal entries, but we understand that the derivative is 22 per gallon. That's the derivative. Okay, very horrible handwriting. Please bear with me. So 31st of December X3, that's the point we stop to find out our journal entries during the month of December, the movement. So the inventory, okay, it increases from $20 per gallon to $23 per gallon. How do we know? Is over here. Okay, I want a smaller one. Okay, it is over here. The market price of oil on 31st of December is $23 per gallon. And then remember, we hold 20,000 gallon. So $23 times 20,000 units is equal to 460,000. That's our inventory. Can you see or not? From this one, from 400,000 inventory, we're going to increase to 460,000 inventory. So later on, we are going to debit our inventory by 60,000. Okay. This can only happen when it is a hedging. If it is not hedging, then it will not happen because IS2, it says we will recognize at a lower of cost versus net realizable value. Okay, because this is a hedging, then okay lah, can do. Okay, now wait. So hedging and also subsequent, okay. And then what else? On 31st of December X3, the derivative price is $24 per gallon. Okay. So you can do either way lah. You use $22 times 20,000 and then $24 times 20,000 also can, but I will use the shorter way. I take the difference because I want to find the movement only, right? So 24 minus 22 is 2 per gallon. So 2 per gallon times 20,000 is equal to 40,000. Okay, so my derivative journal entries will be 40,000 later on. So you see, the inventory we want to increase, so the derivative we will decrease. Okay, there's one hedge gain, one hedge loss. So you don't really have to worry how to figure out what is asset, what is liability, because we are not the finance manager. Yeah. So just like I told you, the inventory is increased by from 400,000 to 460,000 by 60,000, right? So this is the answer. So on 31st of December, we will debit inventory 60,000. From 400 increases to 460. Okay, so you just try to imagine. So when you want to debit your inventory 60,000, you will credit your hedge gain of 60,000, right? So at the same time, you will then have another one called hedge loss, and therefore you will credit your derivative. So you don't waste your time thinking, hey, this is an asset or liability. Actually, you don't really have to think about it when it comes to hedging. Okay, you think about the hedge item, it is easier to figure it out. Okay, so the hedge loss and the derivative is 40,000 because just now we work it out, $24 minus $22 per gallon. This one, okay, times 20,000 units of oil or something. Yeah, so you just combine it together. You see, I want to credit my derivative 40,000, right? So I credit my derivative. Okay, it is a derivative financial liability, and then this one I net it off. Credit side 60,000 minus debit side 40,000 is equal to credit side 20,000. Okay, but the format is not so nice. Actually, it's like debit and credit, make it nicer. Okay, so we will have a profit or loss, credit side 20,000. Fair value hedge, for fair value hedge, our hedge gain, hedge loss, definitely in profit or loss. All right, so this is for question 3. And let's look at question 4. Okay, question 4, 7 got right. Oh, okay. Now let's see question 4. This company has entered into 2 forward exchange contract with a view to hedging 2 specific transactions. Now, in fact, the question asks us, which one is considered as a hedge item? I will tell you the keyword. Now, the answer is number 2. This one is a hedge item. Why? Because there is a firm commitment. There is a commitment to purchase raw materials from a company in other country. Okay, so we sign agreement already. Normally we sign agreement to purchase maybe they need 1 year to manufacture, like the military equipment I told you about the story, and so on. So only when you receive the raw materials, in this case, maybe a year later, okay, then only you will debit the inventory in your book. Before the recipients of the raw materials, you will not recognize anything in your account, but you have already signed, you are committed to buy it already. So normally when you are committed to buy, if you want to terminate the commitment, normally the penalty is very hefty. For example, you have to pay 50%, of the purchase price. Okay, and because of this commitment, this is a hedge item. Okay, this is a firm apa tu? This is a firm commitment, recognized firm commitment. Okay. Now, why number one is not? Many of you answered both, right? Why number one is not? Because of early stage. Early stage of negotiation, it is not finalized yet. Okay. So we are just having meeting, the first meeting, second meeting, third meeting, negotiating about the price, how many years, how long, and so on. Yeah. So this is not considered, it is not concrete yet. It is not concrete yet, and therefore that is not the hedge item. Maybe for some of you, it's like careless mistake only lah. Yeah. For me, maybe I will do the same mistake because looks like almost the same. Okay, now let's see question 5. Question 5. Oh, okay, that's great. This one very easy to. All right. You see, this one mentioned many times already. You see, the keyword is convert. If we can convert, if the holder can convert the bond into a fixed number of ordinary share, okay, this is the convertible note, right? Remember we did the calculation, okay? Convertible note. So this is actually a compound instrument. So if we issue this type of note, we will debit cash and then we will credit liability, but we credit equity, remember or not? Okay, we did this calculation also. So let's look at question number 6. Question number 6, don't know how many. Oh, 3 only. Okay, now. So question number 6, we are the issuer. We issue 500,000, 6% preference share. Okay, you all don't know how to answer this question, meaning you probably didn't do the knowledge check question. Okay, now I tell you the tips. This type of question actually very easy. Now you think about the logic. Now you see this one is preference share, okay, but you don't have the fixed kind of thing to make a decision, right? Whether it is a liability or an equity, right? Now you see it is at the discretion of the holder or the issuer, then you will know whether this is an equity or liability. Now, because you issue note, when you issue note, you are the issuer. So first of all, you will debit cash and then you will credit either a liability or equity, correct? Now, when you have, the question looks like this, okay, redeemable means the preference shareholders can redeem, based on their note, based on their investment, they can make the decision, they can choose. So if the preference shares are redeemable at the discretion of the holder, it will be a liability. This one is liability. If the preference shares is redeemable at the discretion or the option of the issuer, meaning yourself, it is an equity. Okay, again, if the preference shares, ordinary share don't have to say lah. Ordinary shares definitely equity lah. So preference share most of the time it is liability. Okay, you can go for fixed test. If you don't have any information to do a fixed test, then you can look at it like this. Now, if the preference shares is redeemable at the option or at the discretion of the holder, meaning your investor, the one buying your preference shares, they can make a decision. Okay, today I want to get back the money I invested in your company. That one is a liability because they have a say. They have a say. They can anytime get back the money, and so on. All right. So it is like they lend you money only. So no matter how, you have to pay them back. Yeah. And therefore, this is a liability. However, if the preference shares is redeemable at the discretion of the issuer, you have to say. So you wait until you make profit, then only you pay the preference share dividend and so on. Okay. So it is up to you. You can pay this year, next year, next year, and so on. If you have a say, it is an equity. if you have a say, there's an equity, just like the normal ordinary shareholder. You are doing well, you pay dividend to the ordinary shareholder. You're not doing well, then you don't have to pay. It is at your discretion. And therefore, there's an equity. So in this case, it is a liability. All right, so the 30,000 preference shares dividend will then be an interest expense. Therefore, the treatment is not correct. So the treatment minusing out from equity is not correct because these particular preference shares at the discretion of the holder is a financial liability and this is an interest expense. Okay, so there we go. Now let's see question 7. I think about 8 got correct. This one is theory lah. You remember the disclosure? I said, okay, normally disclosure you read on your own, but there's one thing that out in the exam before. There are 3 types of risk, right? Credit risk, liquidity risk, and market risk, right? So the question here asks about the maturity analysis for both derivative and for both non-derivative and derivative financial liabilities. Okay, so maturity analysis is actually a kind of liquidity risk. It is the risk that the company may have difficulty to meet the short-term obligation after converting, the asset into cash. So you can check on this, but this disclosure, not many questions will come out. Yeah. So you can also have a feeling when you do your exam and then you can't figure out the answer. You want to rely on the textbook. How does it work, and so on. Okay. So let's look at question 8. Question 8. Question 8, 3 got correct. All right, let's see what is it about. Question 8, we want to know how the 2 financial assets be classified. If you have a conceptual question, actually normally it's more difficult to answer than a calculation question for financial accounting. Higher level is more difficult one is actually standards and understanding. Calculation is actually considered lower level because you know the formula, you know how to calculate already. Yeah, so it works in that way. So what happened is we have 2 points here. The first one is a loan stock, redeemable in 5 years' time. We hold until it matures to collect the interest payment and the principal amount. Okay, so the business model is a whole model, and then it is the cash flow characteristic is for the sole principal and payment of interest from the issuer, and therefore apparently it is at amortized cost. Amortized lah. We hold until end of the 5th year. We want to collect interest and matured that time we want to get back our principal. Okay, so this is amortized. So number 2, the second one, we have a loan stock. Okay, and it is convertible into equity shares in 5 years' time. We intend to hold the loan stock for long term in order to collect the what is it tricky? This one is tricky. Okay, just try to make you think that we want to hold this until very, very long to receive interest only. No matter how cannot also. What is the keyword here? Why cannot? It is because it is a convertible note. Wait, where is it? Okay. So we want to convert it into equity shares, and therefore we will measure at fair value. Okay. If you have a convertible bond, you will calculate, the amortization for the liability and equity. 250,000 1%. Use amortized to calculate for the securities only. Okay, and therefore cannot lah. A bit tricky here. So the first one is amortized method, and the second one is fair value method, because this is a loan stock convertible.
The star,
yes,
the red
yes.
star means the correct answer or what?
Yeah lah.
The red star means
red
the
star.
correct answer.
You see not red star? Yeah. Is it red star not? The 2 red star.
That just now One question, can you go out for?
Which question? You remember?
The one
now
with
I go
the
out
two
already. Question
transactions.
4. This one
Yeah.
Number 2 is correct.
Oh, okay, never mind. Ignore me.
I thought you know, oh my God. because I explained like, this one wrong, that one correct, and so on. Never mind. I will upload your answer. Like last time, you can see your own answer. I think they also show you the correct answer, right? If I'm not wrong. Yeah. Okay, anyway. I forgot. Yeah. Okay, now we are in question 9, I think. Okay, question 9. Wait, question 9. Don't know how many got correct. Question 9. Oh, one got correct. Okay, never mind. Okay, so again, which one is correct? So I think maybe your calculation is better than your conceptual question. Some students actually will get 50% conceptual question. So God bless you during your external exam. Some students get like 40% conceptual question only or less. Okay, and sometimes you get very, very simple conceptual question, by the way. No. Let's look at this. Which one is correct? Yeah, the answer is 1 and 2. Okay, 1 and 2 is correct. Okay, now, so very tricky. There's one is very tricky. Okay, now, liability is measured at fair value if it is held for trading. Correct, right? If it is a trade model, then we will use the fair value lah, like derivative liability. Okay, so number 2 is a derivative liability must always be measured at fair value. Correct, right? Okay, because derivative, no matter it is a derivative financial asset or derivative financial liability, also have to be measured at fair value. Okay, so it is correct lah. Okay, so number 3, financial liability must be measured at amortized cost unless it is either a derivative or held for trading. The question is trying to say, this one and this one, we use fair value. All others, we use amortize. Wrong, unless, okay. Wait, I repeat. Option number 3, right? I understand. For me, I will also choose the wrong answer if I were to be a student last time. Okay, now wait. This one, it says a financial liability must be measured at amortized cost unless it is either a derivative or held for trading. The meaning of this sentence is, the first one, number 1, this one, okay, we will use fair value. Number 2, this one, derivative financial liability, we also use fair value method. So all others which is not a liability held for trading and also not a derivative financial liability, we will use amortized cost. Wrong. This is not the best answer. This is not 100% correct. Why it is not 100% correct? If you remember standard section, you remember one thing is enough already. We studied guarantee liability before, right? Okay, so if you look at the table, but I don't want to go back to the study guide and so on. Okay, one of the example, guarantee liability, we don't use amortized cost. Okay, so there are some of the transaction, although you don't have to know how to do the calculation. However, there are some of the transactions that we will not use amortized cost, although it is not held for trading or derivative. Okay, that's why this is not good enough. This is not the best answer. Not 100% correct. Almost correct lah, because this is general rule of thumb. Okay, almost correct. So number 4, financial liability should be reclassified. This one I think everybody understand. But you still have to remember if you don't understand or you got it wrong. Now, only financial asset can be reclassified. Financial liability cannot reclassify from fair value to amortized cost or amortized cost to fair value cannot. So only financial asset can be reclassified if the business model change and it is not frequent. It should not be frequent. Okay, so the answer is 1 and 2. So let's look at question number 10. Which one is the essential characteristic of a derivative financial instrument? Oh, I think this one everybody got correct, is it? Let me see. Oh yeah, almost everyone got correct. Okay, now so we have 3 characteristics only. What? right? So it is settled at future date, and then it has minimal or no amount at inception. It does not require any payment exception or minimum payment, right? And then the value changes in response to the change in an underlying item. You can flip your textbook. It means you should be able to get the correct answer lah. Yeah, but if you are careless, then you get the wrong one, right? So it doesn't matter. Just do better next round. Now it exposes the entity to risk. Okay, now derivative is risky as what I've told you. However, we can use a technique called hedging. If you are the one who think too much and choose the wrong one, sometimes students are so good and think too much and choose the wrong one. Okay, now, yes, derivative is very risky. However, we can apply an accounting technique called hedge accounting to hedge against the risk. Hedge against the risk means mitigate the risk, reduce the risk. Okay, so the derivative can be very risky, or it can, like the balik, okay, it can help us to reduce the risk. Yeah, and therefore this is not totally correct. It depends how you use it lah. Like using internet, it can help us to gain a lot of knowledge, but we can also watch a lot of nonsense and become, the worst person on earth, right? So it is like a flip of, the other side of the coin, yeah. So another one, why it is wrong, it is used as a hedging instrument. Not necessary. We have to make sure it establishes the economic relationship. So then only we can use it as a hedging instrument. If there's no economic relationship, then cannot. So basically, there are the three characteristics in the textbook explaining derivative. Okay. So so the answer is 1 and 4. Answer is 1 and 4, C. Okay, after that, question 11, Laila purchased 100%. Sorry, I want to see how many got correct. This one is super difficult. I think none of you got correct. So many got correct. Why? Okay, so many got correct. I thought if 1 or 2 got correct, then I'm going to say something like, you got your luck. Okay, never mind. We are going to look at this question together now. It means you're very hardworking. 31st of March, okay, X8. Laila purchased 100% in terms of shares of Lamina, and then the consideration is 1.5 million. This is the consideration, correct? Why we want to know all this? Because we want to calculate a goodwill due to the purchase of Lamina later on. So we want to calculate consideration minus fair value of identifiable net asset of the subsidiary, then only we will be able to get the goodwill. So that's our step. Please bear with my horrible handwriting. It's always so terrible. So it can't help. So now it can't be helped. So you will see that 1.5 million is the consideration. If it is not mentioned by issuing their own shares or whatever, it will be a cash consideration, by the way, just to repeat. Okay, now, so the Lamina is our subsidiary. So on the acquisition date, subsidiary has all this in the book. Actually, disclose is not a good word. It is supposed to be recognized. Okay. All right, so the fair value of property, plant, and equipment of Lamina amounted to 710,000. On the date of purchase, tax base is 690,000. Okay, so you will find that you see the PPE is 680,000. So we want to increase to 710,000 because that's the fair value, right? Okay, so we want to increase to 710,000. However, you see the tax base a bit tricky here. Tax base is 690,000. Okay, so we will calculate our deferred tax using the revalue amount, okay, because we will increase our carrying amount of PPE from 680 to 710. So our adjusted carrying amount of PPE will be equal to 710,000, and then our tax base is 690,000. All right, so carrying amount is larger than tax base, so it will lead to a taxable temporary difference of 20,000. correct, right? 710 minus 690 is 20, right? So the tax rate is 30%, right? So we will have a DTL of 6,000. Okay, now this is actually the pre-acquisition elimination entry we can do. All right, so this is on the acquisition date. So the first time, and therefore we will take this as the movement. Okay, we will take this as the movement. Of course, the question is not so complete. It is an extract. It should have DTL somewhere already. Maybe it is, somewhere not here. So we are only focusing on the question. We are just doing and calculating the answer according to the question. But this question is actually not very complete. If you can't observe what is it not complete here, then that's fine. Because if you want to make it complete, the question will be a much longer and much more difficult question. So it doesn't matter. So we know there's a DTL of 6,000 and we're going to increase our PPE by 20,000. All right. Now, so the goodwill here, this is the goodwill in Lamina before acquisition, right? Now, internal generated goodwill is not counted. Internal generated goodwill is not counted. And therefore, we will not include this when we calculate our fair value of identifiable net asset. All right, this question is actually very difficult. I don't know why so many can get it correct. Anyway, so now when we calculate our fair value of identifiable net asset, we will try to identify whether we will identify whether this is a correct asset and also liability at fair value or not, right? So this will be counted. Patent will be counted. This is an asset to be identified. PPE will be counted. This is an asset to be identified. So 130,000 plus how much? 710,000. Okay, because we have to increase to the fair value. The carrying amount have to increase to the fair value. So this is counted. Okay, remove the A first, confused. Okay, this asset also counted as 710,000. Okay, and then the current asset 800. All right, no story here, so just copy paste, nothing much. Current liabilities is 400. Okay, and then what else do we have? We have a DTL, right? Okay, DTL is actually a non-current liabilities. So we have a DTL add-on. It is 6,000. Okay, so you try to sum them up. It is equal to 130 plus 710 plus 800 minus 400 minus 6. It is equal to 1234, right? If you sum this up, so we have identified all this as our net asset minus liability. Okay, we have identified all this as our net asset reflected at fair value, and therefore our fair value of identifiable net asset is 1.234 million. We purchased 100%, right? So we use 1.5 million to buy 1.234 million worth of company in terms of shares, and therefore we are paying an extra of 266, and therefore our, where's my pen? Oh, okay. And therefore our goodwill is 266. 1.5 million minus 1.234 million is 266. Okay, now answer is C, 266. I randomize your answer, so I don't know what is your answer, but the answer is C, okay, 266. So let's look at question number 12, conceptual question. Oh, 11 got correct, good. So, 1, 2, 3, okay, now. What are we looking at is regarding bargain purchase. Remember, I think Jay asked this question. How if we pay less than that? I say it is a negative goodwill or bargain purchase, right? So if we pay less than the value of the company, it is known as a bargain purchase or negative goodwill. And if that's the case, then we have to double check again. Okay, we have to double check whether we miss out or we never identify any intangible asset or not, and so on. Once it is confirmed, immediately we recognize in profit or loss, other income in our book as a parent. Okay, so our answer is 134. So we will have to reassess whether it is correct or not. We identify everything already or not. And then we also have to review Okay, we have to review because this will increase the net profit. So we have to be careful lah when there is a bargain purchase. So we have to double check it is correct, and so on. Once everything is checked, reviewed, and reassessed, we will immediately, put it into our other income. It will increase our net profit. Okay, so it is a P or L transaction. All right. So Y2 is wrong. Y2 is wrong. Okay. The bargain purchase should be recognized as a deferred income. No. All right. Unearned revenue is a current liabilities. So it is not going to sit in over there. Yeah. So this is wrong. Okay. Now let's look at question number 13. Okay. Half got correct. Okay. Question number 13. Okay, this one is simple formula, maths formula. Okay, I tell you what, just now you see, okay, now never mind. It is a very good opportunity to understand this before your internal exam, because this is actually very easy. Then later on you will say, so easy only. Okay, now you see, consideration minus fair value of identifiable net asset is equal to goodwill. Am I correct? This minus this is this. Okay, I write down. This is maths. Okay, this is maths. I forgot most of my maths technique already, but yeah, this is the one. So goodwill is equal to consideration minus fair value of identifiable net asset. Correct or not? Okay, like what we said just now, 1.5 million minus 1.234 million is equal to 266,000 goodwill. Okay, now. So let's see. Am I looking at the wrong question? Right. 13. Okay. So okay, now you see, if we want to reflect our subsidiary PPE at fair value, meaning we want to appreciate it. Okay. The question you see always is like, our subsidiary PPE is 690,000, and then the fair value is actually 710,000. What are you doing? You're going to increase the PPE, right? Of course, you want to apply the 30% as the DTL, but eventually you increase by 70%, right? Your reversion reserve OCI will be increased by 70%, right? Okay, so no matter you are looking at the equity, which is reversion reserve, or looking at the asset, we are also increasing. Correct or not? So when you increase the asset, okay, or rather the net asset, you increase. Okay, the fair value is normally appreciated. The property, plant, equipment will increase from how much to how much. Okay, so when you increase this, what is the effect? This is the sign here is negative, right? So when here increase, then it will decrease because the sign here is negative, correct or not? If you want to think about logic, also can. Okay, now let's say I use 500,000 to buy 400,000 value of company. So my goodwill is supposed to be 100,000, correct or not? However, then today only the valuer comes, the valuer say, hey, the subsidiary, there's a property, plant, equipment, we have to revalue upwards. And then, the net of tax is 50,000, make it easier. Okay, we want to revalue upwards. The fair value, we want to revalue upwards so that net of tax is 50,000. So our fair value of identifiable net asset will be increased from 400,000 to 450,000, correct? So I still use 500,000 to buy it, and therefore my goodwill will drop. 500 minus 450 is equal to 50, correct or not? So the higher fair value of the PPE of the subsidiary is the value of the company is higher. So we use the same amount to buy the higher value of company, meaning we untung more, we will not pay that much. Our goodwill will drop. You just think about it. And therefore, but yes.
Like fair value not necessarily appreciate, right? It could depreciate as well, right?
Do you have a question about depreciation?
No, I mean like fair value. If you value it at fair value, it could depreciate because you overestimate the depreciation.
Yes. But not so much in our question, right? So normally when we acquire subsidiaries, it is always appreciate, is it?
Yeah, because the question here didn't state whether the value of it goes higher or lower.
Oh, so what is your answer, by the way?
Never mind.
Yeah. No. That's why it is usually.
Usually. Wow.
I wanted to circle and then no, I'm just very curious. Actually, what is your answer? I want to see whether your logic is correct or not, although you made this comment is correct. What is your answer, by the way?
Never mind.
Never mind. Okay lah. Don't tell me your answer is good. We will be eliminated. Vomit blood later on. Okay, never mind. Never mind. So usually, usually we are not having a recession, right? For example, usually we are not having pandemic, right? So usually when we have a very peaceful society and so on, you will hear that people say, the land and building appreciates and so on. And therefore, all your questions are when you do business combination, when we acquire subsidiary, and the fair value of the PPE normally will be higher. So this is normally, like normally, because it is not, it is more common to have an appreciation than depreciation unless time is very bad. So you look at, the history lah, out of 100 years, maybe 10 years is bad, maybe 1 year out of every 20 years is bad. So most of the time it's not too bad, something like that. And therefore, usually, the word is like usually, okay? So you see and therefore all your question, including your final exam, okay, including your internal exam, when we acquire subsidiary, normally the revaluation is upwards. You don't have a question whereby you have a revaluation downwards. Last time you have, and it becomes a bit more difficult because when the fair value decreases beyond the reversion reserve, you have to expense it off. That one is more difficult, but they're removed from the study guide already. I don't know why lah. Anyway, for business combination, last time until now also the same. Normally appreciate. Yeah, only when it comes to module 1, sometimes the fair value is lower, but it is removed already, by the way. Okay. Very good point. Very observant. Now, let's look at question 14. So my conclusion is like this. Next time, even though, Henry cannot be a good accountant, probably he can be a very good businessman because his view is like very broad. Yeah, but maybe this type of people normally cannot do like very tedious things. When you ask them to do tedious thing, tak boleh pakai lah. You see the boss, already. They like to ask people to do something, right? Yeah. So anyway, this is a personal comment and it is not very relevant, just to make you awake. All right, let's look at question 14. 14, okay, mine got correct. So Jenny acquires 80%. This one 80% you have to be aware. Okay, cannot be careless. 80% is different. Later on, when you do a pre-acquisition elimination entry, you have to remember to multiply 80%. Internal exam also the same. Don't make your assumption and then you just hantam like that. 80% pre-acquisition elimination entry has to be taken into account. All right. So the story here is just draw it. You know the question already. This morning only you did it. So the acquisition date, J acquired 80% of shares in S. And the consideration is 2 million cash, 400,000 $1 shares. So you have to multiply it. 400,000 number of shares. Okay. However, you have to check this $1. Is it the share price on the acquisition date? Then you multiply lah. Yeah. If it is not, then it is not lah. Okay, so you see, blah, 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 blah. There's a market value of Jenny shares on the acquisition date, which is 300 cents. It means this is not. And then sometimes the question will confuse you more. They give you the share price of Jenny company, and then after that, they give you the share price of Smith company. So which one you are going to take? Now, Jenny acquired Smith, okay, by giving out 2 million cash and also giving out 400,000 number of its shares. Jenny issued its shares to buy the subsidiary share. Okay, so Jenny issued its share. Of course, you have to look at the share price of Jenny's, not the subsidiary in this case. So 300 cents, not sure you know now, 300 cents is $3. Okay, 300 cents is $3 lah. 10 cents is $1, right? So this is the share price and this is the fair value of consideration, Remember the formula said this is, we have to find out the fair value of consideration. If it is cash, it is always fair value, you don't have to bother. So 400,000 number of shares times $3, it is 1.2 million. Okay, so 1.2 million times 3 million is 3.2 million. This is the total consideration at fair value. The fair value of consideration is 3.2 million. Then the next thing we want to find out, how much is the fair value of identifiable asset of the subsidiary? Okay, so the question said the fair value is 2 million. Okay, we are going to use proportionate method. So proportionate method, the goodwill is the parent's goodwill. Partial goodwill method, the other name is partial goodwill method. Okay, so proportionate method, partial goodwill method. So what we will do is the fair value of identifiable asset of subsidiary is 2 million. However, we only own 80%. So you have to multiply 80%, which is equal to 1.6 million. Okay, in other words, we use 3.2 million to buy 1.6 million worth of company, and therefore your answer is 1.6 million goodwill. Okay, actually not too difficult. I'm not sure. Maybe you all did wrongly the 1 ringgit one or 80% forgot to multiply. Maybe lah. So the answer is 1.6 million. We use 3.2 million to buy 1.6 million worth of company, and therefore the goodwill is 1.6 million. Normally we use this zero is not correct lah. You will not buy like exactly the same, right? Okay, so let's look at question number 15. This one I think quite easy, right? So we're looking at control. Control is defined in IFRS 10. There are the three keywords, right? Three statements about definition of control, right? So our answer is 1 and 4. So basically, this is one of the keywords. Okay. There is a right, and then it will lead to a variable return, and then we are able to exercise our right to direct and get the variable return. So this is one of the answer, and another one is 1. If we hold 50% and above voting right, we are having a control. If you hold 50% of shares, this is not the best answer. You have to make sure 50% is voting right. Voting right means you are in control. You can vote for this and that. Even you don't want to exercise your voting right, that one is your business. You're still in control. Okay, you're still in control, just like the wife of a husband. So the wife will have the right to check the husband. So even though the wife doesn't want to check where you go, and so on, that one is her business. She has the right, by the way, right? Okay, now, so let's look at number 2. Why number 2 is wrong? The investor has the right to receive income from other company. No. Okay, no. Now, having a control, it will be exposed to variable return. Variable return, it can be positive or negative. If you apply or you work for a positive strategy, a very good strategy, then you will have a positive return. If your strategy is not good, okay, but you think you're so good, so eventually you will get a negative return. You will lose money, I mean. So that's the exposure to variable return. It can be good or bad. And number 3, why it is wrong, the investor enters in the material transaction with okay, now material transaction, it does not mean there's a control. It can be an associate. It can be a significant influence. It can be a related party transaction without a control also can. Yeah. So it is not answering the question of control. It is not answering the question of control. Okay. So when you have a conceptual question, it can be very horrible because it is like playing around with words. Like what Dr. Chok said. One day she grumbled a lot and then she said, the Australian English is so horrible, terrible, and so on. I mean, we get into like this playing field, then we have to do it. The Australian accent is very difficult to understand, but the write-up is still okay, not too bad. If you listen them, speaking their slang, it is very difficult to understand their slang as compared to the UK accent. Yeah. So let's look at question number 16. Now I forgot to see how many of you got correct for 16. 5 got correct, 7, 6. Oh, okay. Oh, okay. All right. So everyone has different view when you did your answer. Huh? Only two questions have the most students got correct. So question number 16, the question asks about control again. Okay, just now I gave you the clue already, by the way. Now we own 45% voting right, and then other shareholder own 5%, and then we have the right to appoint and remove 5 out of 6 members, uh, and blah blah blah. However, we have never exercised our right before, like what I said just now. Now, if you remember substance over form in your study guide, general rule of thumb is 50% and above. However, I think I mentioned a story to all of you, right? If a company, one of the company own like 40 over percent, and then the remaining shares are actually owned by a lot of minor shareholders, okay, actually, in substance, this company is a parent already, remember or not? And then there's another scenario, I think the question in the study guide, another scenario say that, how if we own 45%, and then the remaining 55% owned by two other shareholders, one own, I forgot already, one own maybe, let's say 30%, another one own 20%. Then this one very difficult. It depends, because if these two shareholders combine together, they can actually fight and override the decision. Okay. However, if the question is like this, every other hold like 5%, only we hold 45%. Apparently, in substance, we are the parent. We are in control. We have to prepare the consolidated financial statement. Okay, and then we can direct the activities. We don't exercise our right, that one is our problem, but we can exercise anytime. Okay, so yes, blah 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 blah. So C is the answer. Okay, how about question number 17? Determination of fair value on the date of acquisition. So we are not looking at acquisition, right? So we are actually looking at the fair value of identifiable net asset, right? Yeah. So fair value of identifiable net asset, there are two things that are quite special. Number one is we want to identify if there's any intangible asset not being identified. And number two, we want to identify if there's any contingent liability disclosed in the subsidiaries not to account, we will recognize at console level as provision. Correct? And there we go. This is the answer. Okay. So we will determine the fair value and we will actually recognize it if we are having an acquisition. Otherwise, cannot recognize. Otherwise, cannot recognize. We can only disclose it. Okay. So let's look at question number 18. Which one is to be included in the fair value of purchase consideration? What is this? This is a consideration. Consideration at fair value. So remember our total business combination or consideration, there are many names, okay? Consideration at fair value can also be named as the cost of business combination. And then the common one is we pay money to buy, we issue our shares to buy, or we borrow money so that's our money to buy, or we exchange, a non-current asset to buy, all these are common one. Okay, so the answer is B. All right, so we can actually issue our shares and buy as our fair value of purchase consideration. Then, next one. Like all these, the investigation fee, the cost, all these are expense off. All these are not to be included in our consideration as mentioned. Okay, so question number 19. Oh, 19. I thought just now the question, most of you got it right. Or this question, most of you got it right. Meaning you all are really, really good in calculation. Okay, so this question, right, since so many got it right, I just write it like this. On 1st of September, X2, parent sold to subsidiary, okay, 60,000 inventory for 80,000. So we know that there is a 20,000 unrealized profit because subsidiary has not sold to the external party end of the financial year. Okay, end of the financial year, 31st of December, subsidiary has not sold any of the inventory. So the 20,000 is unrealized profit gross. So multiplied by 0.7, it is equal to 6,000 DTA. Why 6,000? Oh, sorry. Times 0.3, 30%, it is 6,000 DTA. The tax effect is 30%. Okay, so I told you unrealized profit will lead to DTA, unrealized loss will lead to DTL. Okay, so don't have to go through the formula already. Now, what happened is, who is the seller? The parent is the seller, right? So when the parent sold the inventory to the subsidiary, the parent will recognize a sales of 80,000, isn't it? So the parent will debit bank credit sales 80,000. At the same time, the parent will debit inventory. The parent will debit cost of goods sold and credit inventory 60,000. So we have to reverse the sales and cost of goods sold. Inventory no need, because inventory in the balance sheet of the parent becomes zero. Okay, so later on we will reverse from the subsidiary book. So the parent, the parent credited the sales, right? At console level, this is the consolidation entry. This is not the pre-acquisition console entry. This is the console entry. Okay, this is the consolidation elimination entry. Okay, so we at the console level, we will have to reverse, eliminate, debit out the 80,000 sales, okay, from the parent book. And then we also want to credit out the cost of goods sold, 60,000 from the parent book. Okay, now you just imagine the subsidiary used $80,000 to buy the inventory, right? So the subsidiary will actually debit inventory 80,000 sitting in their balance sheet and credit maybe bank 80,000. Okay, so the inventory sitting in the balance sheet of the subsidiary is 80,000, but from the group perspective, it should be the original amount, which is 60,000, and therefore we want to eliminate or decrease 20,000. So you credit the inventory from the subsidiary balance sheet by 20,000. That's how it works. Okay, and then the second general entries is we debit DTA and we credit deferred tax income. Deferred tax income is included in income tax expense, because income tax expense is equal to current tax expense plus deferred tax expense minus deferred tax income. So we combine all this, then you will get the answer. Okay, very good. 10 of you got correct. Meaning you are very hardworking. For the conceptual question, cannot help. Number one, depend on your luck. Number two, depend on your understanding. Number three, depends on your luck. Okay, now the last question is about non-controlling interest. Okay, it is about non-controlling interest. And the answer is C. Okay, now when we have NCI, it means the parent is not acquiring 100% indirectly, right? It is less than 100%, therefore we have NCI. So you remember in our console worksheet, we calculate everything already. And then after that, we split into the last two columns. We do the NCI one for all the equity component, then the remaining one is the parent's equity component, right? Okay, so what happened is the profit or loss is eventually goes to retained earning, and therefore it will be under the equity component. So we will have to calculate the profit or loss attributable to the NCI and also attributable to the parent. Apart from that, we also have to calculate for share capital and also reserve. Okay, share capital, reserve, and also retained earnings. We have to calculate for NCI. Okay, so A, B, and D are not correct. All right, so the correct one is C. Let me see. Wait, if I got correct. Okay, so I'm